stat is that the market will return around 6%, about 5.5% real inflation-adjusted return, global equities.
Yeah.
But the average person will capture 3%. So what's going on there?
Yeah, well, first of all, the average person's doing too much. So, I mean, if you could just say one simple thing, what that tells you is the average person's doing too much. So what they're doing is, instead of just holding and taking the return, they're getting caught up. After a series of good returns, they tend to buy. And there is a sort of mean reversion. This is what we focus on in my course. There is a mean reversion of returns. Maybe partially suspended at the minute, but anyway, we've said that before. And therefore, a series of good returns is probably going to be followed by a series of bad returns. That doesn't mean to say -30, it just means not the 6.5. So when you get a momentum underway, people come in behind it. And the other thing is also true, why they get a poor return. When it's going down, they tend to sell, which is exactly the time to be buying. Yeah. Well, it's not as simple as that. Yeah. Do it, but doing less is the easiest way to get closer to the 6.5. Doesn't guarantee you get to the 6.5, but doing less means it's much less likely you're out at the wrong time and in at the wrong time. Is that right? Yeah, out at the wrong time and in at the wrong time. So that's the reason that they get 3.5 and the average is 6.5.
Yeah. So you talked about this kind of counterintuitive, or people have a basic understanding of like cars, maybe not the markets. The mistake that people might not understand is that what they pick isn't if they're picking a broad index, which one isn't necessarily the most important thing. It's the behavior around it, the consistency in staying in. People would think, I don't want to catch a falling knife. Why would I buy the market when it's expensive?
Yep.
What it shows us is trading around the trade is costly.
Yeah, and we need to be clear what trading is. I mean, I do this for a living. I manage my own money. I probably do 2 trades a year. I consider that probably to be excessive. Now, there'll be people listening to this who do 2 a day. Mm-hmm. So we have to get this right. I mean, if you're making these decisions, I think 2 a year is probably about right. 3 a year is probably about right. You definitely don't want me doing three a week. But there's some people who just confuse trading with investing and obviously think they can do it. But the evidence is that they can't. I mean, okay, there are exceptional people who can do it, but the evidence is that it can't be done. It can't be done by professionals, never mind by talented amateurs.
So why do you do it?
I don't do trading, I do investing.
Well,
so
I
don't do 3 trades a day, I don't do 3 trades a week, I don't do 3 trades a month.
I would say that there's a lot of evidence that people are bad at investing as well, even the professionals, in terms of beating the market. Yeah.
But it gets them closer to 6.
Yeah.
So they may be bad at it, but they're not going to be at 3.5 if they're not trading a lot.
No.
So the point taken, even the professionals don't necessarily get the 6.5. But they'll get a lot closer than 3.5 if they're relatively inactive.
That was a clip from our full-length conversation with Russell Napier, who's a financial history expert. If you want to watch the full interview, you can check it out right here.